the first of a two-part presentation series called How to Purchase Your First Investment Property. So this is part one. It talks a lot more about, the kind of like the theory, or more maybe about the process behind it. And then we get into, some of the more practical aspects, or like how Carmelo and I have actually utilized some of these tools that we're going to be discussing today, and how we've helped other people do the same. So just a little bit about the legalities, just to get them out of the way. We're not tax or investment experts. I'm a real estate agent. Carmelo is a mortgage broker. We obviously have some bias when it comes to the real estate market. So, do your own due diligence, consult your own team of third-party professionals, ask questions, do research online, make sure that before you utilize any strategies that we talk about in any of our webinars, that you are, kind of prepared, and you know what you're, you know what you're doing, or at least you have the expertise and skills behind you to do that. A little bit about Carmelo. Carmelo, do you want to introduce yourself?
Exactly. I would just kind of continue what you're saying again. Alex and I, we're not tax experts. We own investment properties ourselves. So we give you our personal knowledge, but always want to know specific things, legal, accounting, talk to the expert for those specific items. Now, myself, my name is Carmelo Boutis. I'm a mortgage agent at yourmortgageyourway.ca. I've been doing mortgages for over 20 plus years. I've worked for the big banks, the small alternative lenders. Now I'm independent. I work for you. So working for you, what that means is that I could, shop the 59 different banks, trust companies, mortgage financing companies to find the best mortgage that suits your needs. You can find me on Instagram at Carmelo Mortgage, or you can always email me directly at carmelomortgage@gmail.com.
Yeah, and we don't want to discourage anybody from going to their bank, for example, for their mortgage. But at the same time, when you go to a mortgage agent like Carmelo, who has access to the big five banks, and then also tons of other alternative lenders that can help people regardless of everybody has a different situation. It's almost never an apples to apples comparison. And by having access to these lenders and that expertise behind him, I know that he has assisted myself personally, as well as my clients, to get preferable mortgage products that maybe are out of the box as well. Cool. Okay, a little bit about myself. My name is Alex Winiecki. I'm a realtor of Remax Condos Plus in Toronto. I spent over a decade in Toronto's condominium industry before getting into the real estate business. I've conducted well over 65 condominium risk assessments as part of that previous career. And I've been a real estate investor since 2013. So what we're looking to share with this presentation is just, some of the concepts behind real estate investing and how to get started. We're not going to be talking too much about the practical part in this presentation. This is just going to be more theory and concepts. But if anybody wants to connect, my Instagram is your.torontoagent. You can also scan that QR code, and you can get access to my link tree and connect there. So yes, like I mentioned, this presentation is very much an entry-level presentation for somebody who's just kind of maybe thinking about, getting into real estate investment. So the first part is how it works. So it's, the concept behind real estate investment is actually quite simple. I mean, you buy a property with the intention that that property is going to make you money. And how does it make money? It makes money when the property appreciates. So it goes up in value, something that we've seen in the GTA. And, actually Canada-wide, especially in the last, 6-7 years, we've seen a pretty crazy appreciation of property values. During COVID specifically, we hit highs in COVID that we're anticipating that we're going to be hitting again this year. Another way that you make money on your investment property is when you're renting it out and you have a tenant living in there. That tenant is going to be paying down your mortgage. So you're going to be getting equity in that way. And finally, in some cases, you may be able to also find properties that cash flow. Now, in the GTA, for example, it's pretty much impossible to find a cash flowing single family home. So, like a condo that can house one family, it will not cash flow. But there are other options, like multifamily properties, or maybe properties that are outside of the GTA. And another concept that I'd like everybody to kind of think about is that in most cases, your principal residence, while it's important to own the home that you live in is not considered an asset. Does anybody want to maybe speak to why that may not be an asset? You can either unmute yourself or just share in the chat.
That's a good point, Alex, and I'm kind of curious to see how someone would answer that. Anyone want to share their thoughts why your home is not an asset?
And there's a bit of a clue here. This is a Robert Kiyosaki's income statement, which shows income coming in from salary and going out through liabilities.
So, Alex, maybe I'll answer that for some people.
Okay.
Would I not consider? Mila
because your own home cannot produce an income. Very valid, for sure. That's one of the points.
Is it maybe because I have to? I just pay into it. It doesn't give me money, right?
Exactly. And when let's say you own your principal residence, and then you go to sell that principal residence, and then you're taking advantage of that appreciation, and then you need to buy another property to live in. Well, that property has also appreciated just quite as much. So basically, an asset is something that puts money into your pocket. A liability is something that takes money out of your pocket. For example, a car is 100% a liability. It only takes money out, and it also depreciates. So probably one of the worst investments is a car. But with real estate, it's important to own your own home for security, and then also having something that appreciates that you can take advantage of. But at the same time, it's really not an investment like an investment property would be. So in the previous slide, I mentioned that GTA real estate appreciated between 5 to 10% in the last 23 years. This is what that looks like. So this is a chart that I got off Treb. It basically shows the orange is the average price trend, so it just kind of averages out the price of 12 months, and then the blue is the MLS average. So you can see that in 1994, the average sale price in the GTA was about 200,000, and in 2024, end of March, the average sale price for a home in the GTA is about 1.1 million.
Now, Alex, is that all properties in the GTA, or is it just like single family dwellings, or does it include everything? Single family dwellings, condos, townhouses?
So it includes all single family property types, right? So a detached home, this averages it out between condos and I didn't want to have too many lines running, up and down, but this appreciation is something that we've basically seen across all properties. Detached properties are always stronger than condos, but then what we do see quite often is that condo prices lag behind, but then when detached properties get to new highs as far as sales prices, then some people need to kind of tone down their expectations, and they may be getting into condos. Also, condos are like an entry-level product for most people, and most investment properties in the GTA are condos.
The one thing I like about the chart, Alex, is the long length of time. Because I remember back in 2017, you see that spike, that kind of like the little, into the second spike, or the first spike, I guess you should say. Yep. There are people who bought in. There's a fiasco. Everyone was rolling in, and the market was going nuts. And people who bought at that peak, all of a sudden they introduced a stress test, market slowed down, and everyone was afraid, like, okay, the market's going to crash. Long and behold, only 6-7 years later, all the customers I helped purchase at that time, at that peak, 6 months later, they didn't really feel too good. But I'm talking to them now, and I talked to a few of them with regards to renewal that's already passed. Everyone wishes they bought too.
Yeah. So if somebody bought in 2017 at that peak of, let's just call it 900,000. Well, if you just fast forward 5 years to their mortgage renewal, which would be 2021, it would just be basically entry, COVID just started about a year ago, and average property prices is hovering about 1.05 million. So
I'm curious what's going to happen in the next 5 years, because that's that last peak that we had. If that's going to then look like the previous in 2017.
Well, I mean, I have a little bit of a biased view on it, I guess, as a real estate agent. But what we're hearing is that and what we're seeing is there's a lot of pent up demand in the market because of the current higher interest rate environment that we're in. The market is starting to get more comfortable with it. We're seeing, like, for example, the orange line is March this year versus the gray line, which is March of last year. So we do see that, February, March, we had a little bit more activity, not as much as 2022. Like the peak of the market in the last 3-4 years was around February, March of 2022, just before they started to increase interest rates. But we're seeing consumers showing up. Now it's something that it's really dependent on property type. Freehold properties continue to go up in value. There's parts of the GTA where we've never seen things like multiple offers even stop. Like if you go to parts of Vaughan or Richmond Hill, multiple offers never went away, regardless of what the interest rates were. But there's a lot of pent up demand, and basically everybody's expecting that when the Bank of Canada starts to lower the prime rate, everybody's just going to enter the market at the same time, and we're going to hit the previous high of February 2022.
We will find out. It's interesting. I like this chart, and I look forward to seeing it as the months go by, how it changes, that red line.
Yeah, and this is available to anybody. I mean, this is not like, all you have to do is go on the Toronto Regional Real Estate Board website, and there's market stats, and you can access this and do your own due diligence and get this information for yourself and interpret it yourself. So I guess the first step, towards purchasing an investment property is doing some self-reflection and evaluating the financial situation that you're in.
Yes. So the first step, if you're looking at buying an investment property, is, you got to really understand and see how much you qualify for, right? Because when you're buying an investment property, all investment properties, you require a 20% down payment. And you have to remember there's also closing costs. You're no longer a first-time buyer. Well, you could be a first-time buyer, but if you're buying investment property, there's a good chance it's your second home, and you don't get that land transfer tax credit anymore. So the banks want to know you have money for down payment plus closing costs. Now, where that down payment could come from, it could come from selling investments you have. You could refinance your existing property or properties to get that down payment. You could, add a home equity line of credit or second mortgage to the existing home that you have, or you could draw from personal savings. You can also get gifts from parents. There's multiple sources, but you really have to understand you have to have a lot of money to, especially with today's prices, to put for down payment.
Yeah.
And you want to see that what you qualify for, because now you're going to show that you could carry 2 properties.
Yeah. And if anybody in this presentation joined our 6 o'clock presentation, we talked about home equity line of credit and a second mortgage and how that's different. But if anybody missed it, we are going to be sharing a recording of it on our YouTube channel over the weekend. Hopefully I'll be uploading it tomorrow. So you can kind of check it out and see how to do that. Because one of the beautiful things about real estate versus, let's say, investing in an asset like a stock is that you're getting appreciation on the full value of the asset. You're not just getting appreciation on, let's say, the 20%. So let's call it, if 20% is $100,000 on a $500,000 property, you're getting appreciation on $500,000. Where
Yes.
if you were to take that $100,000 and put it into the stock market, you would only get appreciation on that, basically
That 100,000.
Yeah, the principal investment. So
So that's the first step, right? So just an example, if you want to take equity out of your home, let's say the value of the property is $500,000, right? So you could refinance your home with a second mortgage line of credit. We could have a separate conversation about that one-on-one. You could everyone could refinance a home up to 80% of the current value. So what's that calculation? You take the value of $500,000, you multiply that by 80%. So that means a new mortgage can be increased up to $400,000. Your existing mortgage could be at $220,000. So you're not getting $400,000 in new money. They can subtract the balance that you have outstanding. So the amount of money you'll be able to take out of your property is $180,000, and that $180,000 can be used for both down payment and closing costs.
Yeah, and that's in this scenario where you have a property that has a $220,000 mortgage, and it's it has a current market value of $500,000. Is it market value? This is how they determine this, right? Like an appraiser market value, right?
Market value is determined by an appraiser valuing the property to confirm what the value is.
Yeah. So the next step, and actually I think that this is probably the most important step, and that is the property. So this all kind of ties in together. So the property type, the property location, um, essentially, I'm a believer that you want to buy the cheapest house on the best street. You want to buy in a market that can support the high caliber tenant pool that you're looking for to sustain your property. Like there are smaller markets in the GTA. Like if you go out to places like Smith Falls or Timmins or Sudbury, where you can potentially get into a property at a maybe half the price of something in the GTA, or even less. But then you have to also look like, who are the major employers? Like what brings people into that market? Is population growing? Is the population declining? Does it have a major financial institution? Like ultimately, you want to be in markets that are growing, and it goes both hand in hand. So not only are you going to be able to get higher caliber tenants in markets like that, supply and demand and people coming into that market is also going to move up your property's value. So you're going to get to benefit from it in both ways. So I did a quick just like Google search. I put like, what are the top municipalities in Canada. This came up on Wikipedia. This is a little bit dated. This is from 2021, but that's what they had posted on Wikipedia. So ranked Toronto is number 1, Montreal is number 2, and Calgary is number 3. I know that these are all great markets. I myself, have started to invest in Alberta real estate just because of the opportunities that exist out there to get into what I see as the equivalent of having invested in the GTA 15 years ago. And still, with people moving out to Alberta, employers moving out there, just the affordability, property values are going up very quickly, but you're also able to get those high caliber tenants that are going to assist you, are going to give you peace of mind that basically your rent is going to be paid on time.
Yeah, you want to be in a good market because, again, if you're in a market where the city's growing, there's good jobs, you'll find good tenants and the value appreciate. If you're going to be buying in a small market where people are exiting the city and the population declining, over time, the value of that property will decline. And again, it'll be harder to, your home may stay vacant for longer periods of time between tenants.
Yeah. And, ultimately, Canada is experiencing its largest immigration boom, I think, ever. We're growing faster than any G7 country. And most people that are coming into Canada, they're coming to Toronto, they're going to Calgary, they're going to Vancouver. Some are going to Montreal, but those are really the main cities. I mean, we do see population going up in places like Kitchener, Waterloo, because of their tech sector, and then also because they have the University of Waterloo and other universities out there as well. But ultimately, my personal recommendation is to get into the best market that you can. It may not be the desired property type. Like maybe your goal is to buy a freehold property, but you can only afford a freehold. Like maybe your budget is only $600K. So then you're kind of faced with, okay, for $600K, you can get a condo in downtown Toronto that has an abundance of AAA tenants. You can also get something in Calgary, but you can't buy a freehold property in the GTA. And continuing to save and wait until you can, you're just going to find yourself further and further out from, achieving that goal, because you can only save money that quickly, even if you're investing it in stocks, or other vehicles. But real estate prices are just going to continue to outgrow. You're going to continuously find yourself trying to catch up to the market, and sometimes it's just about making a decision, and then once you have entered, being able then to do things like a home equity line of credit or a second mortgage, or to leverage that investment towards continuing to grow your real estate portfolio. Like leverage is, I think, really what makes it a lot simpler, because once you own one property and you've experienced some appreciation on it, you can buy, and I've done this myself, buy a second property by just taking out a second mortgage, using that as your full down payment and covering all your closing costs. And you're taking on the mortgage, but you're putting a tenant in that property right away. So you're essentially not having to come up with any new money, but you're getting a second property.
So again, the key thing is that once you know what you qualify for, you really got to make a decision on what type of property you're buying and location, right? There's a lot of different opportunities today. You could look at buying a property on assignment, Alex. Are you looking at buying a condo? Are you looking at buying out a province? Calgary is a very fast-growing city. Or maybe all of the above, right? So once you know what you qualify for, which is the first step. Second step is determining the property type, location. What are your goals with this investment? and
Yeah.
then finding the opportunity that matches your goal.
Yeah. And the reason why I mentioned these three assignments, condos, and Calgary is because I think these are like where the major opportunities exist right now in Canadian real estate. And it's sometimes you can get fixated on what's the perfect decision, what's the perfect entry, the perfect timing. But really, I think that any of these three options you're going to do well in. But it's just about taking that step, and having that expertise behind you. So, not going into it by yourself, engaging, for example, an agent early on to talk about your investment needs so that they can actually like tell you like these are the current opportunities that exist in the market. Because somebody who's not in it, working in it on a daily basis, they may not know or may not even have access to some of these things. Like assignments, they don't advertise assignments on the MLS unless they get special permission from the developer. So in most cases, you can't. There's opportunities in GTA resale condos, opportunities in Alberta that some agents may not have access to. Like they may not have platinum access to projects out there. So it's about like, I think that you will do well whichever of the current opportunities you decide to move forward with, but it's about taking action.
And Amila, you wrote a message in the message board. Victoria, Kelowna, BC, Canmore. Again, there's opportunities all across Canada. We're not here to say one opportunity is better than the other. It's just, you got to find your own goals, decisions with regards to what works for you.
Yeah. And I'm not familiar with, the BC market so much. I know that in Victoria, I think there's a sell-off of micro condos that's happening now because there were a lot of investors that were buying out there for the purpose of short-term renting these condos. And then the province, I think, restricted them or banned them, and now there's like a major sell-off in that market as well. So, those markets, like I'm not too familiar with BC, but you want to see who are the major employers. Is the population booming? Is it just based on one sector or just two? Like you want to basically go into a market that's very mature and developed if you can. But if you, let's say, live in those markets like in BC and you are familiar with them, then that might be the right opportunity to take. But I don't know about those markets to speak
again,
about.
I think those opportunities are everywhere. Like in those micro condos, it's just it's a niche within. It's not like it's all Victoria. It's not all Kelowna or Canmore, right? So
there's no opportunity.
It's finding the right.
They're being sold off.
Yeah, well, but but maybe you're not buying the investment property. Might not be the investment property you're looking for. Maybe it is. Maybe it's something off, and we don't know, right? If we knew the future, life would be easy. But now, once you found your property, that's the key thing. Once you found your property, you know what you qualify for. You found your property. Now we actually have to get into the actual financing. Pre-approvals are only good as the paper is written on. So once you find the property, then we know you're buying a house, townhouse, multiplex, right? Condos. There's again, like if it's a condo, it's a new condo, old condo. Is it a house? It could be a duplex, multiple tenants, more income. That's all going to be identified when we actually get the formal approval for this purchase.
Okay. And closing the purchase.
Yeah, once you get the mortgage, you're approved. You made the offer. You close the purchase. Congratulations, you're now a landlord, right? So the process is simple. First step is see what you qualify for. Second step is finding the property type and location and investment that you're looking for. Third is making an offer, getting accepted. Fourth is closing it, and then finding tenants, right? Finding tenants. Finding tenants. You can find tenants. We're working with a realtor like Alex. Alex can help you find caliber tenants and help filter. As I mentioned at the very beginning, there are tenants that come up with fake documents, which Alex can identify quite quickly. And again, when you find a tenant, you want to find good tenants, right? And when I say good tenants, you're building a relationship with them. Right. So you got to set certain boundaries.
Yeah, it's important. I had a landlord that she got a call, like we just rented out her property and the tenant called her and like literally I'm not even joking. They called because some light bulbs burned out. So she, got in her car, drove down to the property, changed the light bulbs. And she called me about it. And she was all like, oh, they called, I resolved. I'm like, yeah, but now you're going to be replacing all their light bulbs. Like today's favor is tomorrow's duty. So we do have another presentation that we do about kind of, becoming a landlord. That might not be the solution for everybody. There are property management solutions that exist, throughout Canada. So there are real estate agents that can manage your property for you. There's property management companies that can manage your property for you. Engaging a realtor may be beneficial in pre-screening tenants because we're a lot more in the market, like how I was describing to Carmelo. I received another letter today from the same company, through a prospective tenant that submitted an employment letter, which I pretty much recognized right away as being fake because these employment letters have been floating around for over a year in the GTA market, and kind of all agents are now aware of what to watch out for and look out for. So it depends really, I guess, on how hands-on you want to be in the process. If you're going to be hiring a property management company, you're probably going to be looking to shell out about between 5 and 10% of the monthly rent just to how to manage the property for you. Jaydeep wanted to ask a question. Can you shed some light on getting into commercial real estate investing? So commercial real estate investing, it's anything over 5 units. So I guess you're talking about like multifamily residential. Okay, so I think, I believe he's talking about multifamily residential. I know that the financing structure for that is a lot different. That's much more advanced than kind of what this particular presentation is about. But it's basically anything that is over 5 units is considered commercial, and they look at it completely differently when approving financing, if I'm not mistaken, Carmelo.
Financing a multiplex is different, but Jaydeep, I just want to make sure I understand. Because I also help people purchase industrial units, retail stores. What type of commercial financing? Can you write it in the group? What type? Can you explain what you mean by commercial financing or commercial real estate? So Alex, again, I know I've helped some people who want to buy.
Can you guys hear me?
Yeah, go ahead, Jaydeep.
Yeah, sorry to cut you off. Actually, it meant that, it could be multifamily properties as well. But yeah, like you said, industrial units and anything commercial real estate, I'm pretty interested in that. So I'd really like to, get to know your views on that in the GTA.
So I'll speak with financing for a little bit. Alex, I don't know how familiar you are.
I'm
with
not a
regards
commercial agent, so I can't
Yeah.
speak to commercial real estate, really.
Commercial financing is very different than residential financing. If you're buying like a building to invest in, the banks are looking at the cash flow of that unit, and a lot of times the valuation, the appraisals. Commercial financing is a lot more expensive when it comes to the cost of doing it. An appraisal, depending on the unit, could take anywhere from 30 days to 90 days. You may require environmental assessments. For example, if you're buying a garage or something where there's like work and chemicals involved. Or even retail stores, right? If there was a hair salon in there or a nail salon, there are going to be more costs to it. When it comes to investing, I'm definitely not the expert in it. I've helped a few people with commercial financing, but I don't want to, I can't really say I'm sure there's opportunities, but we got to look at the math behind each one. Because it's very different than your typical single family dwelling, duplex, threeplex, even multi-unit residential. Numbers are different than buying a duplex. So there are opportunities. It's just what's the property and what are the numbers behind it. That's how I identify whether it's a good investment or not. I usually use numbers. I take the emotion out of it. So I hope that answers your question when it comes to the mortgage part.
Yeah, the commercial part, I mean, it's all about cash flow, and I think on the real estate part, so like the forced it's almost forced appreciation. So if you have if the properties are tenanted, if you're not going to be able to get vacant possession, you're going to have to assume tenants. You want to do some due diligence about how much rent they're paying, and then also opportunities to maybe, as people move out, to renovate units and be able to get more rent. And then, I think that also as the property generates more rent, and may open up some other opportunities for the financing part, right, Carmelo?
Again, it's different. Commercial is just. Maybe we could do a presentation about that, Alex. So it would be a hard presentation because it's not for the average person.
Mm-hmm.
Everything everyone knows about residential financing is the exact opposite for commercial. Well, not the exact opposite, but it's very different financing. So let's kind of stick this with what we're presenting, because this is, again, our theory. I think next week we'll be sharing our actual examples.
Yeah, sounds good. Is it true that we cannot make money enough by renting a condo unit? Someone told me that. So yeah, if you're going to be getting a condo in the GTA, it's going to be cash flow negative. So when somebody purchases a condo in the GTA, they're purchasing for appreciation. It's not everybody's cup of tea, because you are going to have to. It's basically a forced savings account. You're going to have to put money out of pocket every month. But there are markets where you can get condos that are close to cash flow, like in Calgary. That's one of the opportunities that kind of has drawn clients that I've worked with out there. I do have another webinar where I share my experience investing in Calgary and in Alberta, and also I do have some good access to different pre-construction properties out there. But some things that you may not be aware of when you're getting into real estate investing. This is one of the benefits, and you want to run this by your accountant. Like, don't take your word for it, but don't take our word for it. But this is what we've experienced: is that expenses related to the property are tax deductible. So when you start to run that, investment property, you're essentially running a business. You now have opportunity to write off things like your travel to and from the property. If you're doing upgrades or rentals, or you're paying somebody to manage the property or to help you find a tenant. Even some of the closing costs are tax deductible. And I believe that the interest on your mortgage is tax deductible as well for investment properties, right, Carmelo?
Yeah, no, that's my understanding on investment properties. The interest it's just the interest you pay on your mortgage. The principal you pay down is not included.
Mm-hmm.
You give give your annual statement to your accountant, and the annual statement will show how much interest you paid for the last 12 months.
Mm-hmm.
And the accountant does what the accountant does.
Yeah. So yeah, like I mentioned, and to answer Mila's, I guess to go over Mila's question again, is that condos in the GTA, after mortgage, property tax, maintenance fees, they're not going to be cash flowing, but it's a different investment strategy where somebody's just purely investing for that appreciation. And there are really good opportunities that exist right now, but if you're looking for cash flowing condos, you got to look at other markets like Calgary or Edmonton, or maybe other kind of smaller places like maybe Windsor.
Yeah, the condos, again, it really depends on the property location, and when owning real estate, it's a long-term investment. It's not a get-rich-quick scheme, right? Because again, it takes time for that tenant to pay the mortgage down. In time, even if you're buying a property today, maybe whether it's cash flow positive or negative by a lot, it'll take a little bit more time for rent to catch up, so you're breaking even. But those those that are just slightly cash flow negative, it won't take too long for the rent to creep up and make it neutral and cash flow positive. And at the same time, the value will appreciate. There's multiple ways to make money off the investment property, but all of them take time.
Yeah. And to answer M. David's question, how long will you be in the negative? 2 years, 5 years? I guess it's about the negative cash flow in condos. I mean, it really, I cannot answer that question. It depends on the property that you get, but also it depends on future rent projections and interest rates going down. So if interest rates go down significantly and rents go up significantly, then you can find yourself in a neutral position quicker than if, I don't know, another pandemic happens and people leave the GTA, leave the core, right? So there's a lot of variables there, but I think that if you're going to be going into that type of investment, you need to budget for that and make sure that you are okay that, for the next, let's say 5 years, you may have to put money out of pocket. You have to be ready for that, because you don't want to find yourself in a shortfall or a speculative situation. Like, real estate is not a speculative investment. Like, it's something that should be gone into with some planning, and it's not like Carmel said, it's not a get rich quick buy and get out, unless you're buying a tear down and you're doing a renovation and then flipping it. That's something different.
That is different, and that has its own risk, right? So real estate, again, if you're buying it for a 2 or 5 year time horizon, I personally consider that extremely short. Real estate, you should be looking at 10 years is like a short term, but you should be thinking 15, 20, 25. Those who have been extremely successful with it, and those who own like multiple properties and are really, really rich, that I want to be, they bought properties a very long time ago. They just held on to it. And from that chart at the very beginning, you saw how prices just go up.
Yeah.
You buy it for, 700,000 today. Who's to say 20 years from now it's not worth 1.5 million?
Yeah. It's all about time in the market, not timing the market, as we've said before. So yeah, we'll open it up to some questions now. If anybody has any questions that they want to ask us.